Okay. So, very good evening to all of you. Today we are going to share from the topic of national income accounting. This paper is Economics for Finance. And the core of this paper, if you understand, I'll share a few things. So the layout will go as per 4 norms. Number 1, that why this paper has been offered to you in intermediate. Number 2, what all topics should be covered in this. Number 3, that how should you prepare for your exams. And number 4, that why should you go for taking care about the concepts along with the application part. So these are the 4 points we will be sharing all throughout when we will be going for taking it forward from here onwards. Okay, so that is very important for all of you to understand. So number 1, economics for finance, why this has been offered to all of you. It has been offered because you are students who are going to become future maybe auditors, accountants, or the role of chartered accountants is changing over the period of time. Why is it changing? Because you see today we have e-commerce firms, we have players from fintech, we have international collaborations, and you can see how the world economy and the boundaries are squeezing day by day, and how the role of accountants are changing over the period of time. Reason being the books entry in the books is changing over the period of time. You can see we have started following as per the international norms. We have to take care about that how international bodies want us to be matching up with the international norms, because we have foreign players in India. So we have to give them a level playing field with respect to the domestic players. So all these factors keeping into consideration, your governing body, that is ICI, has taken care about giving you that platform where you can understand basically that how economics and finance are correlated. So we are going to share that. Before that sharing, I want to share very important aspect here, that the first and the foremost topic which we are going to cover today is national income accounting. Before we talk about national income accounting, what are the parameters of national income accounting? Why is it significant for you to understand? Number 3, that what will be the flow of this chapter 1, national income accounting. So the first and the foremost, like business units. Okay, for example, we say business units. So business units, what's their job, or what you as an accountant have to see as a chartered accountant or as an auditing firm? What do you have to see in that? You have to see that which entries are there in the books, isn't it? Number 2, you have to see that from where the money is coming. What is the source of revenue? How the sales figures are changing over the period of time? What are the cost component? How they are investing in R&D and capital and others? And 4th, how the industry is behaving, where that firm is in existence, and what policy measures are taking place which are making impact on that firm, which depicts about the financial health of that firm. And this helps you to decide about that what will be the future potential of that firm in the market, depending upon the demand potential or the policy measures and others. Similarly, in the same manner, economy's health has to be measured. Why is it important to measure economy's health? It is important to measure economy's health because economy has different components. Components are, you have business units, you have individuals like me and you have foreign players, you have corporate, you have small and big players, you have investors, you have lenders, you have borrowers. So they are different players. All these are subunits of the economy. And if economy is performing well, definitely, in that case, what is going to happen? If economy is going to perform well, that means all the segments will be doing well. So that is what is national income. So what we are doing here in national income accounting, we are maintaining accounts of the country. And who was the one who proposed first this? 1930s, Simon Kuznets, and second was Richard Stone. These were the 2 macroeconomics players who got Nobel Prize. They had proposed this. And the objective of proposing this national income accounting was because you can measure that economy is transiting from agriculture to industries, from industries to service sector, how the income is generated over the period of time, how income distribution is happening, which segments are growing, how the production is taking place, and Which sectors are generating more income, which is creating more demand? Which sectors adding more value addition? So these are the different components which we need to know about. So that is what is captured in national income accounting. Number two, national income accounting also takes care about that the cost of living of people is increasing. If it is increasing, is it because the cost factors leading to increase in cost of living? Is it because of the other components which are contributing to higher cost of living? How the income is distributed. It talks about the distribution of income also. Distribution of income means that are we having equity in income distribution? Which sector in the economy is generating more income? That sector is generating more income because the demand is more there of that sector, and the demand is more there because people are buying those products. So expenses. So what it takes care about? It takes care about expenses. It takes care about income, distribution of income. It also takes care about value addition. Value addition in terms of production. So what goods will be produced which are in demand? If those goods are in demand, there is expenses for those goods. If there are expenses, that is source of income for the third player. So national income accounting basically takes care about three core parameters. That is number one, production. Number two, production leads to what? Value addition. Value addition from A to B. That means I say from automobile segment today, or you say about the other segments which are there, let's say processed food. So these are the segments where they add value. So value addition to production. Then you have expenses. Expenses done by whom? By me and you, other corporate, other people, those who create demand. So demand creates expenses. The third component is, since you go for expenses, that creates income. So income. So the three parameters of national income accounting are production, expenditure, and income. Production is also known as value added method, because value added means you are adding value to each step, right from the production, from the farm to the final good which is available in the market. And you have also done the concept of GST and VAT, you know about. So that is about value addition at each step, what is there. So these are the three things which we will be taking care about. So I've already shared with you people that first and the foremost, why economics of finance is important at intermediate level, because economics and finance are complementary to each other. You cannot sustain one without the other today, because the market is changing. The market has become highly dynamic, and keeping that into consideration, you, the future chartered accountant, should know about market, because you can maintain, you can audit, you can be vigilant about what are the financial transactions are entered in the books, and how is it going to change over the period of time, what kind of risk the firm may be having in future. That's why it is important to understand. I've already shared that this paper is about numerical plus concepts. So you should know about from both the perspective. Number three, that you have to look for concept development, numerical, for that you have to do practice, and number three, precision in your answer by correcting real life examples. So these are the factors which are important for this paper. What we will be sharing in this particular session will be about meaning and significance of national income accounting. Why is it important? Number two, what are the concepts of national income? Number three, how it can be measured in India. Limitations, challenges, and few methods will be taken in the other session. Because within 2.5 hours, what is important is that you should understand all the concepts which we are going to share here. Okay. So national income accounting is a double entry bookkeeping system. It is used by governments to measure how a country's economy is performing. So you read in the newspaper that countries developing, countries underdeveloped, countries having recession, countries are having inflation, hyperinflation, and so on and so on. So these are the factors which you come to know about. Countries are having higher growth in e-commerce, countries are having higher growth in agriculture products, and so on. So this is all you come to know through national income accounting. Number two, I've already shared, it has three components of measuring national income accounting. One is through value added method. Value added basically means from the farm to the final consumer. What is the value added? from the industry to the car on the road, value added approach. Number two is income approach, where it talks about distribution of income. Distribution of income means who gets how much income. This depends on your skill, your caliber, the demand in the market, and other factors. Then the third is expenditure method. Expenditure, where you spend money, expenditure. So these are three ways of calculating national income. Country like India, it is very difficult to go for segregation in these three. So sometimes they go for clubbing together three when you calculate for the entire country. So we can have value added method for industries, we can have income method, we can have expenditure method for the unorganized sectors, and respectively for the developed organized sector, we can have expenditure method. For unorganized, we can go for the value added method, and so on. So this is how we have to go for clubbing together all the concepts or rather calculation when we calculate national income in India, because it is highly fragmented market in India. Who maintains accounts in India, national income accounts in India? Central Statistical Organization maintains national income account. And there is a Ministry of Statistical Program and Implementation, MOSPI, which maintains statistical accounts of the country, national income accounts of the country, which helps government to make policy measures. So you see MSMEs going for policy measures, Government of India introducing. Government has gone for interest subvention for the players because of the COVID cases. Government has brought IBC to take care about firms and bankers. So this is how the bankers were getting affected because of that. So to bring more discipline in the corporate, these all policy measures are based on which sector is doing well, which sector needs more improvisation, where should policy matters should support that particular segment, where the inflation is leading to bad impact, and accordingly taking measures. So these all policy measures are taken care through national income accounting. It gives insights about how the economy is performing. So 1930, Simon Kuznets and Richard Stone, they started the concept. They brought this revolution in the field of national income accounting. They connected that economic growth of country is dependent on switching over from agriculture to service sector, to manufacturing sector, to service sector. And that is what we keep on comparing India and China over the period of time, what led to success of one at a faster pace as compared to the other. So this is what these two Nobel Prize economists, they shared about. Now, when we talk about national income, it is measured through the goods which are available in the market at a market price. So the concept introduced was market value of final goods and services, and the second was income. All countries across the world, they follow national income accounting based on United Nations System of National Accounts, which is also known as SNA, System of National Accounts, proposed by United Nations, which was published first in 1953, and this is the basis of all national income accounts maintained all over the world. So, national income account significance is clear to all of you. I can't see your questions and others, so I'm just trying to, I hope it is in process. I will be sharing all questions of yours if I'm missing over here because of some technical problem. In the end, we'll devote half an hour for all your questions and queries. So don't worry on that account, okay? If I'm not able to address at this point of time, it will be taken care for sure. So national income accounts is about fundamentals. We will be sharing about details, how will we go for calculating it. It takes care about population data. You can connect with population data. Youngsters are more in India. What is the level of employment? Is employment generated in manufacturing sector? Is employment generated more in service sector? Yes, service sector of India is contributing more towards. So that is why Government of India over the budgets, if you have seen in the past few years, is constantly working on strengthening agriculture sector, because agriculture sector, number of people, those who are employed in agriculture are more, but their contribution in GDP is very less. That means their contribution in national income is very less. So that sector needs to be, need hand-holding. And that is why agriculture is given more importance during the period of time. Other sectors that entrepreneurship and startups. So this, you come to know why it's startups today, because youngsters are more and they have a higher risk appetite. So giving them job opportunities by promoting Skill India and others. So this is how national income accounts give uh, details about health policymakers to connect with population data, per capita income, where it can be generated over the period of time. It also helps to know about that where the labor norms are defined, where the labor norms will be defined, that will help to know about how many organized sectors are there, how many unorganized sectors are there. If unorganized sectors are more, then the case of income distribution will be more fragmented. Fragmented means will not be streamlined. There will not be defined labor norms. So over there, they need to work on bringing them more in organized sector. If not, labor laws should be more defined. So this inside government gets through national income accounting. Then other is about financial and monetary. I've already shared, you might have also gone through a number of times. So the to bring more discipline in the financial sector. Why books of banks are getting stressed? Because NPs were increasing. Why NPs were increasing? Because companies, corporate, which were taking high leverage, they were not paying it back. This was resulting in high NPA. So they brought IBC. Manufacturing sector, which was not able to contribute much because of the lacunas in the tax system and fragmented tax system in India. So they brought GST. So these kind of reforms, which you see in the market, they introduced excise duty benefits in terms of petrol. Why? Because petrol was the sector which was the escalating cost of many business units, and the increase in the cost of these units were leading to what? Leading to low profit, and low profit means low demand, and the impact would have been low capital market returns. So to take care of that, what government did? Offered benefits in terms of excise duty on petroleum and others. So this is how. So you get insights from national income accounting, like the way you get insights through books of firms. What policy measures to be taken, how should we strategize, and everything. So similarly, national income accounts is kind of a Bible for a country to know about that how country is performing, where country is lacking, what kind of measures to be taken, and so on and so on. So that is the significance of national income accounting. I hope it is clear to all of you. What is the significance of national income accounting? Not able to see your questions, I will be taking it as we proceed. So we have already shared there are three methods of calculating national income. One, from the production perspective, you can calculate how much total goods and services are produced in the country. So I say that wheat is produced and then the harvest bread you get in the market. So from the raw wheat to processing, to manufacturing, to packaging, to supply, to logistics, and finally to you as a consumer, you're getting each step value is added. That is taken care through production of goods and services. That is value added method, which we call it as gross value added, GVA. Yeah. In is it okay now? Okay. So production of goods and services followed by income distribution. Income distribution is about that if you are producing goods, you're producing goods because there's demand. Who's creating demand? You're creating demand through consumption and investments. So that is expenditure method. And this leads to what? Income generation. Because you're producing goods, that means you're hiring people. So these are factors of production. What factors? Anything you produce, anything you produce. You may produce chalk, you may produce bike, you may produce car, you may produce anything. What are the basic factors of production you need? You need land. So for land, you have to factor payment as rent. You need what? You need capital. For capital, you have to pay interest. You need what? People to work on machines. So that is, to those people, you have to pay wages. So that is about wages, salaries, whatever you say about. Then followed by profit. So you have to go for profit for the risk taken by the entrepreneurs. So that is about the risk taken. So these are the three components along which the national income of the country is calculated. Now, the most important is GDP. What is GDP? GDP is the fulcrum of any country. So you say US is developed, India is developing country, Nigeria is less underdeveloped country as compared to India. So that is what we talk about. So how do we categorize countries as developed, developing, underdeveloped countries? That is based on GDP. You might have seen that in the newspapers, you see GDP growth rate is 8%. GDP growth rate of the country is, IMF has projected that it will reduce because of pandemic. It will reduce because of Russia-Ukraine crisis. So what is this GDP? GDP is, if you fragment these three letters here, gross domestic product. Gross means which is inclusive of depreciation. Domestic is within the domestic territory. Domestic territory means within the country. Production is production of goods and services. So whatever goods and services are produced in the domestic territory is summed up together. That gives you GDP of the country. And this very important term which you can see over here is final goods. So you can see here final goods. Can you see this? Final goods and services. So this final goods and services is about what? This is final goods. You see, final goods and services. So what do you mean by final goods and services? Final goods and services is deducting all intermediate goods. For example, I say that you go for producing bread. So you are Britannia manufacturer of bread. Okay, so you're manufacturing bread. So to manufacture bread, and let's say you're manufacturing atta bread. So manufacturing atta bread, you need what? You need wheat. Wheat is produced by whom? Farmer. So let's say the farmer has produced wheat at 100 rupees per unit, let's say 100 rupees. So the manufacturer, you have got wheat from the farmer at 120. So 20 rupees is the value added. So you got it for 120. Now from 120, you're going to produce bread. Then you'll go for packaging, and then it will go to dealer, and then finally to the retailer. So at each step, let's say from wheat to bread, and then from the bread to packaging, supply, and final good. Let's say the bread is costing you 150. If it is costing you 150, it started from 100 rupees. So if you start counting from 100 to 120 to 130 to 150, what are you doing? If you go for counting it from the farmer, from the manufacturing to the supply, to the dealer, and finally to the consumer, if you go for counting at each step, what's happening here? You're counting n number of time, wheat, bread, packaging, and finally. So final goods and services means the end use of the good. End use of the good can be for consumption, end use of good can be for investments. That is final good. So that is very important to understand. Money value of all final goods and services. Money value, why money value? Because you may have apple in kgs, you may have cloth in meters, you may have milk in liters. So you can have capital in terms of units. So different units of goods produce different units of measurement. So to have a common unit, we calculate in terms of money value of all final goods and services produced within the domestic territory of a country within a year. You can go, why is it written particular period of time? You can calculate quarter-wise also. So you can calculate quarter-wise also, you can calculate yearly also, you can calculate half-yearly basis also. So what is GDP? GDP is the money value of all final goods and services produced in the country during a year. So during a year or over a period of time, so that is about final goods and services produced in the country over the period, in a domestic territory of the country over the period of time. So this is about GDP. Okay. I'm not able to see students' queries. I really don't know why is it so. So if technical team can check for that. So what is basically happening here? Growth in GDP is because of two reasons. When the production will increase because of two factors. Either you go for labor, rest of the labor, you increase the labor number, one. Number two, productivity, two. So you can increase labor in terms of quantum, you can increase their productivity, output will increase. You can have capital, machines and equipments, technology, which are more advanced, production will increase. So increase in available resources, like in India, we have more labor, we can have more skilled labor, so production will increase. We can use modern technology, we can use best of the production process, which will increase production. So that is about increase in the GDP. These are the two factors. And the other is productivity. Obviously, you have more trained people, you have more skilled people, you have higher and better technology, which can help you to go for higher production. So GDP of the country will increase. So I hope it is clear to all of you. What is GDP? GDP is money value. GDP means production. Fulcrum is production. Production of what? Goods and services. Goods and production of what? Goods and services? Final goods and services. Why final goods and services? Because intermediary goods and services, if you go for taking, then in that case, it will lead to double counting. So you cannot go for taking intermediate goods. So we do not take intermediate goods. That is one. Number two, how GDP of the country will increase. GDP of the country will increase over the period of time with increase in labor or maybe increase in capital. And at the same time, increase in productivity of labor and increase in productivity of capital. How can you increase productivity of labor? By making them more skilled, trained. And other capital you can increase by enhancing the technology. So that is how GDP of the country will increase. And GDP depicts what? Production within the domestic territory. So for example, I say that Samsung having its unit in India. Samsung is a foreign player. Samsung producing mobiles in India or anything in India. Will it be counted in GDP of the country? Yes, definitely it will be counted in GDP of the country. Why it will be counted in GDP of the country? Because Samsung is having its unit in Indian domestic territory. That is why it is a part of GDP. So gross domestic product means value of all final goods and services produced within the domestic territory of the country. Okay, so this is clear. So you can see here sector-wise. So sector-wise contribution of GDP. You can see here what is the contribution of different sectors. Sector-wise, you can see GDP contribution in agriculture sectors, fishing, mining is just 20%. Public administration defense is 15.42%. Then about financials and real estate is 22%. What is the significance of sharing this with you people? To tell you people that agriculture sector, people employed are more, but their contribution in national income is less or in GDP is less. That is why Government of India working on strengthening agriculture sector. So how did they come to this conclusion? They have got insight through this contribution of different sectors in the GDP. If you see construction sector is 7.16%, trade and hospital sector is 16.42%, where the sectors which are contributing less in GDP, they need to be empowered so that their contribution can increase. You can see here service sector is contributing 53.89%. Industries are contributing just 25.92%. So we are service-driven economy. To make it industry-driven economy, what we need to work on industrial sector, for industrial sector and agriculture sector. So this insight, how did they get? They get through national income accounting by taking care about GDP of the country, which depicts about contribution of different sectors in the economy. So it helps in policy measures, it helps in terms of supporting particular sector and so on. So I've already shared what is the concept of intermediate and final goods. Intermediate goods are the goods which are used during the production process, which are not used for final consumption or investments. Final goods are the goods and services which are used for final consumption and investments. So intermediate goods are goods and services are which are used in the production process. Final goods are not resold because it is used for consumption, final consumption or investments. But intermediate goods can be resold, can be transformed. Like we shared from wheat to flour to bread to final. It can have different components, multigrain bread and so on. So you can go for transforming it from wheat to multigrain bread. That is about intermediate good. But final good is multigrain bread, which is available in the market, which is available for consumption. So intermediate goods not used during a year. So suppose you are a firm, you are having certain inventory piled up with you and you didn't use it during that particular year. So it's going to be used for the next year. That means it is a final good. You're using it for further investment in the next year. So that's a part of final good. So intermediate goods not used during a year are a component of final goods. Now, if you use machines and equipments during the production process, they are not intermediate good because they are part, you go for deducting it as consumption of fixed capital and that is quoted as depreciation. So this is not intermediate good in that case. Okay, so machines and equipments which you are using over a period of time in the production process will not be considered an intermediate good. It will be consumption of fixed capital, which you take care as depreciation. So when you come across the word GDP, when you come across the word gross value added, what is gross value added in GDP? It is about value of output. What is value of output? Let's say price of wheat per kg or per quintal is 1,000 rupees. Just an assumption, 1,000 rupees per quintal. Units produced, let's say, is 100 units. Just an assumption. So 1,000 into 100 is 100,000. So 100,000 is the value of output. Okay. Now, when you calculate value of output, you have to deduct all intermediate goods which are used in the production process, their price. That gives you GDP of the country. So GDP, and what is net domestic product? You know from gross to net. How to go from gross to net? Gross to net is when you go from gross to net, you deduct depreciation. What is depreciation? Depreciation is consumption of fixed capital. So when you come across the word NDP, NDP is net domestic product. Net domestic product means you're moving from gross to net. Gross to net means you're deducting depreciation. That is consumption of fixed capital. Now I can see. Okay. I hope you can see my slides now. Okay. Can you repeat gross value added? Okay. Gross value added basically means that value added at each step. For example, wheat. I took example of wheat. We are sharing example of atta bread. Okay, atta bread in the market. So atta bread in the market is about what? From wheat to wheat flour. You have wheat flour, which is from the farm. From wheat to flour. Value added from wheat to flour. Flour to bread. Value added from flour to bread. Bread to packaging, distribution, and then to dealer. Value added from the manufacturer to the dealer. Value added from the dealer to the retailer. Value added from the retailer, and then it goes to final consumer. So the value is added from where? From the agriculture, from the manufacturing, from the service sector. So the three segments have added value at each step. If you sum up the value at each step, that gives you the total price of bread which is available in the market. If you start counting the price of wheat, if you start counting the price of flour, if you start counting the price of bread, which they have made, raw bread, still not packed, if you start counting the price of travel, packaging, advertisement, everything, what are you doing? You're counting multiple times the product which will be there in the market. So to avoid double counting, what we do, we go for final good. Final good is, what is final good here? Bread, which is available for whom? Available for the final consumer. This is good. Similarly for services. Okay, so that is why depreciation is included in GDP. See, there are two ways to calculate. One, normally what you see is countries, they calculate, they categorize countries in terms of developed and underdeveloped by taking GDP. Because consumption of fixed capital it is a nomenclature which is followed. So the countries all across the world, they practice calculating GDP, that is gross domestic product, rather than calculating net domestic product by deducting depreciation. When we want to calculate for India, for specific, to get new insights about, is the consumption of fixed capital making more impact? So we have to work on depreciation component. So that's more important for a country-specific perspective. But when you go for inter-country comparisons and when you go for quarter-wise comparison, then it is better to go for GDP. This is how it is practiced in the world market also. I hope it is clear. So final goods and intermediate good is clear to people. I hope so. We have already shared a baker or a bread maker, whatever it is about, uses flour to make a cupcake, then sells the cupcake to a customer. So cupcake is a final good. What is intermediate good? Intermediate good is flour. Okay, so that is why we calculate the final good. So bakery might be using intermediate services like internet services to promote its products, packaging and delivery. These are all not counted because once the bakery is going to sell the cupcake, they'll include every cost of theirs in that. So that is the final value we go for calculating. Okay, so intermediate final is clear to all of you. Yes, it will be based on ICI material only. Fixed asset consumption means that you buy a machine. Let's say you buy a car. You buy a car and that car you have purchased, let's say in 19. We are in 2022. So you go for using it over a period of time. There's wear and tear of the car, which is going to depreciate the value of the car. And then when you go for selling it today in the market, that means it will be they will be deducting the depreciation. Depreciation is basically wear and tear and the cost which you have invested and the life cycle of the product which you get over the period of time. Okay. So I hope it is clear to you, Sumit. Fixed asset consumption. Consumption of fixed asset means depreciation. Using the fixed assets over machines which you are using, equipments which you are using over a period of time, they have a specific life cycle. And over the period of time, their value decreases because you're consistently using it. That is depreciating that value of that asset. That's what is called fixed asset. Okay, so it is clear. So economic and non-economic activities, which are economic activities which govern certain price. Those are economic activities. So your mama going for helping, making food at home. There's no price attached to it, but you go for having it from outside. Maybe it's from dhaba, maybe it's from 5-star, maybe it's from any restaurant. You have to pay price for that. So that is economic activity where it generates some income, where there's a price attached to it, which is traded with price in the market. That is economic activity. Non-economic activities are that is not exchanged in the market and governs no price. So non-economic activities are activities you pursue some hobby, you go for some activities which are not generating any, which is not having any price as such. So these are not taken care in normal course of calculation of your income. So when you calculate income of the family, how do you calculate? Your income which you get through the sources, but you never calculate the component which your mama may be very good in terms of, your father may be very good in terms of IT skills, but he or she is contributing at home only. But if you outsource those services, you have to pay for that. So that is economic. Once you use it, your own skill and services from family members and others, Non-economic because you're not exchanging it in the market, it is not governing any price. Flow concept, flow and stock. What is flow? Flow is national income is a flow because you do not calculate national income. It's a sum you get over a period of time, isn't it? You get income over a period of time. That's a flow concept. Stock is at a point of time. At a point of time when you calculate, it is known as stock. So you say that the amount of salary which I got today is 70,000, 60,000, 40,000, 50,000 is at a point of time. But over a period of time, when you calculate my salary for the month is so and so, is flow concept. So flow concept is over a period of time. And so development is flow, growth is flow, national income is flow. Expenditure is at a point of time. You can say I've spent this much amount of money. Okay, so flow and stock is clear. Then capital goods. What are capital goods? Capital goods are goods, machines and equipments, plants and others, which are plants basically means we want to say that you go for plants, you understand. No, we are not talking about those green plants. We are talking about plants and equipments, machines and equipments, which you go for establishing. Okay, so these are capital goods. What are inventories? Inventories are which add on to the production process over the period of time. So inventory can be the form of raw material inventory. If you have inventories which are not absorbed in that particular year, so that adds up to your investments. You need not go for further investment in inventories. You already have that, which can help you to produce further production process, helping you in further production process. So if net inventory is positive means what? You already had specific amount of raw material. The demand in the market was less, and that is why you have left some inventories with you, which you can absorb for the next year or for the next quarter. That is net inventory is positive, which is added up in GDP because that is not used. And we have already categorized what is used, what is invested, are the final. So you are using it for further investments. Inventories which are used further, that is known as final. That is why it is not intermediate. So inventories are clear. Then why do we not include stocks and bonds? Because you see companies which have issued stocks. So let's say ITC IPO or Facebook IPO, which came long back, but people have their shares till date. That doesn't mean that they're raising money today. So that means it is not included. But the broker which is going to sell you those shares, their commission will be included because that is, they have sold you, they have rendered their services today, so that will be included in national income. So these are some concepts which you should know about. Then national is about what? National is about the people, those who are resident of that country, normal resident of the country, national. So for example, I say that when we talk about domestic can be, I told you, Samsung in India, producing in India is part of Indian production. Okay, Apple in India is part of Indian production. But when we talk about national, it will be part of US. Because Apple is from which home country? From that country, that will be the part of their country because it's about residents of that country, they will be getting that income, part of that income. So residents of the country is part of national. So whenever you come across the word domestic, that means within the domestic territory. Domestic territory means whosoever is working, maybe MNC, maybe domestic. That is working in the domestic territory, that is why it is domestic. But once we use the term national, we are talking about residents of the country. Okay, so resident unit is, which is resident unit? You're talking about business unit now. Resident unit is a business unit having its economic interest in the economic territory of the country. So what they are there for 1 year or more than that, irrespective of nationality. So for example, Amazon in India is resident unit because it has economic interest in economic territory of India. And they are there for more than 1 year. Ola and Uber in India. So it is about irrespective of which nationality, but they have their economic interest in India for more than a year. So they are resident unit. I hope it is clear to all of you. how is that intermediate goods are treated as final goods when it needs the transformation into any form? See, if you're not, my screen is hanged till now. Is it so? Flow concept is basically, I've shared, Gerald, I've shared flow concept is when you talk about over investments, investments are flow. Why investments are flow? Because you invest over a period of time. Okay, expenditure can be at a point of time. GDP growth rate, which you say today, what is the GDP growth rate figure, which you say is at a point of time, but the development happens over a period of time. That is a flow concept. So flow is over a period of time, which you cannot quantify at a point of time, which you always have to measure over a period of time. That is flow. Okay. So is my screen hand, Riddhi? Can't you see it? Okay, so another concept which you should know, very important, is production tax and product tax. Production tax is tax which is imposed irrespective of how much units of good you are producing. So it is nowhere related to units of good produced. It is not specific to a good or service produced. It is about, suppose you buy a land, you have to pay registration charges and others. You have to pay stamp duty. You have to go for factory license fees. You want to establish factory. You have not started production yet, but you have to pay factory license fees for that because you are entering in a particular segment. These are production taxes. Stamp duty and others. So these are not related to property tax and others which you have to pay. So these are all production taxes. So I hope you differentiate between production taxes. Can you do your screen ratio 50 so that we can see you and the slide equally? Can't you see me? You can't see me. I hope so you can see me. Okay, so production tax is clear to all of you. Production tax is not with respect to how much units of good you have produced. It is with respect to you want to start certain unit, certain venture. So you have to pay certain taxes for that. You may produce, you may not started producing yet, but you are liable to pay taxes. So stamp duty, factory licenses fees, you have to go for pollution tax and other taxes, property tax and others which you have to pay. So these are all production taxes. Product taxes, tax which is imposed on you based on how much units of good you have produced. So sales tax, for example, service tax, for example, excise duty. These are all what? Product taxes. And what do you do in the case of product taxes? You pass it on to your final consumer by escalating certain price. So product taxes. Product subsidies. What are product subsidies? Like subsidies given by government on fertilizers to farmers, specific to product. That is product subsidies. Production subsidies. What can be production subsidies? Production subsidies are, you are working in SME sector, small, medium and medium enterprises segment, and you are given interest subsidies. Interest subsidies, you understand? Interest subsidies is that, for example, you go to a bank to take a loan, and the bank is offering in a normal course at 7% rate of interest. So government says, no, it is MSMEs, small and medium enterprises, so you have to give them interest subsidy. So rather than offering at 7%, you have to offer them at 5%. So what are you doing? You as a lender, you are giving subsidy to these micro and small enterprises by 2%. That is what? That is production subsidy. Why it is production subsidy? Because you are not giving subsidy to micro and small medium enterprises for specific product category. You are giving subsidy to micro and small enterprise because they are in that segment. So that is production subsidy. So you understand production subsidy and product subsidy specific to the product. So subsidy given to specific products. For example, Government of India giving subsidy to oil because they believe that that is leading to high prices. So let's give subsidy so that the price will not pass it on to the final consumer. Because if product subsidy is not given, it will escalate the price of the good. And if the price of the good escalates, means who is liable to pay? Consumer have to pay. So this may lead to higher price level in the economy. So that is why they offer subsidies. So fertilizer subsidies given to farmer. Why fertilizer? Ukraine, we were importing maximum fertilizers from Ukraine. And because of this Russia-Ukraine crisis, fertilizer prices have gone up like anything. And if fertilizer prices will go up, our import cost has gone up. And in that case, farmer will not be able to afford to go for using fertilizer. So government will offer them at subsidized price. For which segment? Only for fertilizer. So that is product subsidy. So I hope you understand product subsidy, production subsidies, production tax and product tax. You are able to differentiate between these. Riddhi, what is your query, Riddhi? You are saying to share the screen half. I don't know whether it will be. What is factor income? Okay, so Jayant is asking about factor income. Factor income is basically, I say that I told you for anything, you produce a chalk, you produce car, you produce bike, you produce food, you produce anything. What are the basic things you require? You require land to establish your unit. So land is one of the factor. And this land requires what? Rent. If you're using your own land, that means you're foregoing that income. So that means that is the rent, which is called as imputed rent, which we call it as. Okay, so rent is one of the component for the land. Second, if you have land, you have to have some basic machines and equipments. So machine and equipment is what? Capital. So capital, you get it through what? You have to pay the price of capital in terms of interest. So capital factor income is interest. Then you have labor to work on that machine. So labor is a factor, and the income of the labor is wages and salaries. Then you as an entrepreneur have started this venture. You have taken some risk. So you as an entrepreneur, you get paid for your risk in terms of profit. So that is a factor income of an entrepreneur. So these are the 4 components. Okay. Production refers to which goods? It is referring to the production of 8 core sectors of growth: electricity, steel. Everything in an economy, there are n number of goods produced. So production refers to every good and service produced. It can be depending on which segment you're talking about. So it can be cement, electricity. Absolutely, you're right. For everything. Production here we refer to everything. It can be for anything and everything. We are talking in terms of taxes and subsidies, where government imposes taxes, where government offers subsidies. Cement and fertilizer will be product. Coal and oil will be product. But sector will be, or starting a venture would be production. Like I told you, MSMEs is production subsidies. Like you students going for higher education, so education loan subsidies given for higher education. It is not product specific that you go for this particular education will offer you. Okay, so that is the concept of production and product tax and subsidies. Now the another important concept is real and nominal. Yes, notes will be uploaded. Product taxes, clear, Ayush. Product taxes, tax imposed on specific. For example, I say that cigarettes. Government of India want to discourage people to smoke. So they have put higher tax rate on cigarettes, product tax. But ITC, when they are manufacturing on their manufacturing unit, where they started their unit, the cost they had to pay, the tax they had to pay for starting this venture is production tax. Ayush, it's clear? Subsidy basically means to I'll give you example to make you understand. Subsidy basically means like, for example, I told you about that the market price of fertilizer, let's say, is 100 rupees. Okay. So if you go and buy in the market, you get it for 100 rupees per unit. But me, the farmer, is getting at 80 rupees. So how come I'm getting at 80 rupees? Who is meeting that gap of 20 rupees? Government is paying for that 20 rupees on my behalf. So subsidy is, this is subsidy. So that 20 rupees is subsidy. You're getting it. So subsidies reduces the price of the good. And somebody has to pay for that reduction of the price. So either the government will pay or some that normally the government pays when we talk about subsidies here. So if you have heard about tax, if you've heard budget, you might have heard about that government has offered subsidies for agriculture products. Why for agriculture products? Because they want the price to be lower. So what is the impact of subsidy? The price goes down. What is the impact of taxes? It increases the price of the good, you see. So which good prices will be higher? So you buy luxurious products, whether you buy branded products. So that over there, the tax rate is higher, so you get it at a higher price. You go for necessity goods. Over there, the prices are low because the tax rate is low. So what is the impact of taxes? Taxes escalates the price and subsidies reduces the price. And these two components are of what? Product taxes and product subsidies, because we're talking of specific to the product. It's clear? Yeah, I will be sharing you with all these PPTs, some exercises, some government of documents also. Apart from that, it is very important to go through your papers, which were questions which were offered prior. We'll share this in one of the classes, in the end classes. So don't worry on that. All numerical questions and the questions which were asked in prior papers of yours will be definitely, over the past few years, will be definitely shared. And I'm trying to cover everything from your question papers as far as possible. So if the fundamentals are clear, you will not find any difficulty in attempting any of the numericals. Okay. Notes will be uploaded. So what is the difference between GDP? You might have come across in the newspaper, GDP is at 6%. 6%, I'm talking very low, 8% and above. 9% also we were expecting. So when we talk about GDP, what you read in the newspaper is nominal GDP. What is nominal GDP? See, GDP, when we talk about production, you talk about any production, you can fragment that production in two components. What are the two components? One is how many units of good are produced and what is the price per unit, isn't it? So price and units are the two output, are the two components of production, isn't it? Now let's say that you have produced 100 units of goods. Let's say that there are 100 mobiles produced, and these 100 mobiles produced were at price of 100 rupees, just a hypothetical for simple calculation purpose. Okay, so 100 units of mobiles produced at 100 rupees. So the total price output value will be how much? 100 into 100. But if I say the price of mobile has gone up to 200 rupees. Now units of mobile produce 100 units only, but the price is now 200. So what is the product value? What's the product value? It is double of the previous. But actually the number of mobiles have increased? No. So what is happening? It is nominal GDP. Nominal GDP means you're taking care about price as well as output. And price, so you can see here, GDP at current price. GDP at current price means, can you see this here? GDP at current price, GDP at current price means 20, 21, 22. So we are taking price of 21, 22 and we are taking output of 21, 22. That is GDP at current price, that is nominal GDP. But to nullify the impact of price increase, like I shared, if the price of mobile increases to 200 rupees. So 100 into 200 is how much? 20,000. No. So basically what is happening? The price is increasing. So, but when we talk about 100 rupees and 100 mobiles, price is half. And that is why the figure is half. So real GDP, when we go for taking it, what we do, we take mobile production in the current year 2022, but we'll take price of base year. What do you mean by base year? Base year is the year where the prices were much stable. So in India, we have taken base year as 11 and 12. The government is working to take it as 15 and 16 and further. They are working on it, but we are following at present base year as 11 and 12. So what will we do? When we'll calculate output of the country of different sectors, what will we do? We'll take output, physical units of as same of different sectors. But price we will take off which year? Price will take off 11 and 12. Why do we do this? We do it because if we take prices of the current year, what will you see? You will see that GDP figures have highly escalated, isn't it? Because the price level is increasing. You see how prices are going up over the period of time? So output may not increase, but since prices have gone up, with increase in the price level, the product value goes up. And this gives wrong impression to people that, wow, our economy is growing. But what exactly is increasing here? Only prices are increasing, output may or may not increase. So to find out actually the output in the economy is increasing or not, what we do, we keep prices as constant. What do you mean by prices as constant? We take prices of base year. And that means the prices are not going to change with respect to price remains same. Now you calculate output of the GDP of the country in 2020. You take prices of 11 and 12. You calculate output of the country in 2022, but you take prices of 11 and 12. So both cases, whether you're talking about 20, whether you're talking about 21, whether you're talking about 22, you're taking output of respective years, but price you're taking of which year? You're taking of 11 and 12. Why we are taking 11 and 12? Because that is what Government of India has decided about as a base year. So what you read in the newspaper, GDP growth rate, that is nominal GDP. Can you see here? The same year GDP. We are taking GDP of quarter 21-22. Nominal GDP you see is how much? 51.23 lakh crores. But when we take real GDP, then the value comes to 32.38 lakh crores. Do you see the difference here? The growth of GDP for real GDP is 20.1%, but growth for nominal GDP is 31.7%. So this difference here of 11.6%. What is the reason of this 11.6%? It is core because of inflation going up. Inflation, what is inflation? The price level in the economy is increasing. So is it clear to all of you? Nominal and real is clear? Yes, nominal includes inflation. You're right, Prakash, you're right. You can write also, in the NPs explain stock and flow. Sure, Riddhi, I'll explain again. Okay, so this is clear. Nominal and real is clear to all of you. I hope so. So you have to remember two things here. Number one, what you read in the newspaper, what you read in any piece of information which you get from any of the government official bodies, that is nominal GDP. Nominal GDP means what are you doing? You're taking prices of 2022, you're taking output of 2022. If the price level in the economy will increase, GDP figures will go up. But if you calculate real GDP, then in that case, you have to take price for that particular product, which was in 11 and 12. So price you will take of 11 and 12, multiply it with output of the 2022. And that is why you see the difference here of 11.6% in GDP growth rate because of the price level which has gone up. So real and nominal GDP is clear to all of you. So basically what happens because of price level going up? It inflates GDP, isn't it? It inflates GDP. Like you see balloon, if you go for filling it with air, gas, it gets escalated. You can see the bigger form of it. So basically economy is getting escalated. It is projected to be an escalated figure form. Why? Because inflation is infusing in it. But if you want to diffuse that inflation, what do you have to do? You can calculate GDP deflator. So what is GDP deflator? GDP deflator deflates inflation. It diffuses the impact of inflation. That is the role of GDP deflator. So how do you calculate GDP deflator? GDP deflator is nominal GDP to real GDP. It is a ratio of nominal GDP to real GDP. So either you can calculate nominal GDP to real GDP, you can get the value of GDP deflator. If you do not know real GDP, so you can simply take real GDP on the left side. You know nominal GDP, what is the current GDP level? If you know the GDP deflator, you can find out the real GDP value. So what is the role of GDP deflator? GDP deflator tells you about what level of inflation in the economy. And it deflates the impact of inflation. That is what is. So if you want to calculate inflation rate in 2 years period of time. So what will you do? You will calculate GDP deflator in year 2, that is nominal GDP to real. And in the current year, divided by current year by the last year by last year into 100. So that gives you the value of the GDP. We will be sharing numericals later. Don't worry on that account. Okay, real and nominal once again. Okay, real and nominal is, you see here, if I can use, okay. So this figure, if I talk about price, okay, so price is the one component. Second component is quantity. I'm sorry, I will be using that other means later, but you can see here price is one component and output is other component. Now, if I freeze this price, what is going to happen? How I'm freezing this price? By taking price of 11 and 12. But output I'm taking of which year? I'm taking output of the current year. So now, since I'm taking price of the base year and output of the current year, and now if I go for multiplying these two, what will be the outcome? Outcome will only be reflected because of the change in this output. Prices will remain same. So when you take price of the base year 11 and 12, you take output of 2021, 22, you are calculating what? You're calculating real GDP. But if you go for taking price of 2021, 22, output of 21, 22, then in that case, you're getting which GDP? You're getting nominal GDP. Okay, so this is the difference you should know about. Deflation again. Deflation, I'm not saying deflation, I'm saying deflate. It helps to deflate. Deflate, inflate, you understand, Snehal, inflate, you understand. Inflate means, inflation leads to what? Inflation leads to escalate figures. Escalate figures means you see higher values. Okay? And deflate means you remove that impact. You remove that impact from escalating from escalating, and that gives you the real picture. That is the concept of deflating. Deflation is a different concept, Snehal. Deflation and inflation are poles apart. Inflation is, Karthik, you're right, why the base year is so outdated. I know this. Government of India is working on this. They are working on this 15 and 16, and they want to go for revising it over the period of time. So they're working on it, and they will be they have revised it for 15 and 16, and they will be further revising it to 2021 over the period of time, because they want to match up with the current. You know, one factor also, Karthik, because if we go for changing the base year over the period of time quite frequently, you're escalating GDP of the country, no? Because the price level is going up, so GDP goes up. That's another way of making people be feeling happy about, wow, our country is growing. Real income calculation. Yes, I'll write for this after the break. I'll write. Don't worry. I'll write for all numericals here. Don't worry. I'll write. Don't worry, Kaveri. I'll write. Okay, so within the boundaries, you can see GDP and GNP difference is clear to all of you. What is GDP? Do remember, D stands for domestic, N stands for national. National means the people, citizens of the country, residents of the country, which are staying in India. They may be having their venture abroad. So whatever they are investing abroad, from that, whatever proceeds they get it back home is part of national. But Amazon in India, Uber in India, Netflix in India, whatever they get, they take it back home is minus. So national is basically the citizens of the country which are investing in the country, which are investing abroad, they are bringing it back home to the country. It is only residents. But when we talk about domestic, it is irrespective of resident. They are simply in the domestic boundary of the country. So we share Samsung, we shared Apple, we shared Amazon, we shared Uber. All these players are part of domestic because they are operating in the domestic territory of the country. So domestic and national, you understand the difference between the two? So national is with respect to the net factor income from abroad, which I will be sharing. Net factor income from factor income, you understand what is factor income? Factor income is income of land, labor, capital, and entrepreneur. So people working in India, Indians working in India is part of net factor income within the country. Foreigners working in India taking back home is minus. Indians working in Infosys bringing back home is plus. Okay, so IBM operations in India, they are taking it back home is minus. Mahindra having its venture abroad, Tata having its venture abroad, bringing it back home is plus. So national is about plus NFIA. NFIA is net factor income from abroad. What is net factor income from abroad? Factor income paid abroad and factor income we get. The difference of that is national. Domestic, you understand? Okay. Where real GDP is used and where nominal, Ankur, very valid question, where nominal GDP is used and where real GDP is used. For all official data, which is communicated, which is disseminated to people, is nominal GDP. All nominal GDP. But when you want to quantify the impact of inflation, then you go for real GDP. When you want to, you remember we have shared initial significance of national income accounting. So how inflation is increasing. So inflation is increasing because the oil prices are going up. Because Indian rupee is depreciating. Because of that, import bills are exceeding. There it plays an important role that where the prices are going up, where you want to find out what are the components of price leading to higher nominal GDP. If you want to work on those price components, it is very important to understand real GDP. It is also important to understand real GDP with respect to taxes and subsidies. So these are the important factors where you have to study about real GDP. Okay. So this is about real and nominal, real GDP and nominal, I hope is clear. Domestic and national is clear. I want to share 3 mantras of national income accounting, but I'll share it by writing it, because that then only it will be more easy for you to retain. So I will be sharing that after the break, once we'll go for it. But here you can understand gross national product. What is gross national product? I've already shared. In GDP, you add what? Net factor income from abroad. What is net factor income abroad from abroad? Factor income, what we receive from abroad. Factor income, what we pay abroad. So the example quoted here, I have quoted is Taiwan-based firm, Wistron, is the manufacturer of iPhone. Close to Bangalore, they have established, where they are manufacturing iPhones. And it's a Taiwan-based firm. So since it is a Taiwan-based firm operating, having a factory in India, it is part of domestic. So it is part of GDP. But it is not part of GNP, because this firm is from Taiwan. It will be part of GNP of Taiwan because they are the nationals of Taiwan. So you understand domestic and national, please do differentiate. Make a virtual picture in your mind, image in your mind. When we talk about domestic, you have a circle. Within the circle, it is in the domestic territory of the country. Domestic territory in the country means within the domestic boundaries of India. That is domestic. You may be a foreign player, you may be Indian player. As long as you're producing, you're contributing in terms of output, it is a part of GDP. But when we talk about national, you have to take care about net factor income from abroad. And normally what happens in a country like India, things are changing over the period of time. But what happens, net factor income from abroad normally is negative. That means factor income, those who take it outside India is more than what we get it from rest of the world. And if it is negative, then you understand that in that case, GNP will be less than GDP. So sometimes, this is also very interesting question, that is it possible that GNP of the country is less than GDP of the country? So answer will be yes, in case if net factor income from abroad is negative. What it means? It means that what you pay to the rest of the world is more than what you get from the rest of the world. Factor income, you understand, factor income is rent, interest, wages, and profit. So can we take a break and then we start again? Is increase in inflation relating to real GDP indicates that country is growing over the years? See, if inflation is increasing, then in that case, output is also increasing. If you say real GDP is increasing, that means inflation is increasing less than the increase in the output level, isn't it? So output is increasing at a faster pace. If output increases at a faster pace, then increase in the price level, obviously, GDP will increase. Because GDP is a product of what? It is a combination, it is a component, it has two components, price and output. So if output increases at a faster pace than increase in price, obviously, nominal GDP will increase. Because it is not increasing more because of price, it is increasing more because of output. So if prices are increasing moderately, but at the same time, output is increasing at a faster pace, it's good for the country, no? It's good for the country. But like, Venezuela. Venezuela had a hyperinflation. Hyperinflation means prices over there were increased to 1,000% increase in the price level. So if the price level increases at this pace, then in that case, if you calculate GDP, your output may be very less, but if the price level is increasing at that pace, that means you are not getting the real picture of the economy. So that is very important to understand, that when inflation is a problem for your country, then real GDP is more important. When inflation is moderate and you can anchor inflation at a specific point, then definitely you can go for nominal GDP. Okay, so we can take break and then we can start again. Mukta didn't understand real. Absolutely, Sumit, absolutely. Shruti, IoT is Internet of Things. Internet of Things, you understand the software which they are using it for iOS system and others which they go for. So they use software in your mobile, no? So they're taking care of the Internet of Things. IoT is Internet of Things. So whatever you do, you book your order on Swiggy, you book your cab, is all because of IoT. You can trace traffic. This is all because of IoT today. We are connected today because of this online, isn't it? So this is how. So can we take a break of 10 minutes and then we'll go for it? Technical team. Okay, so I'll take query of Sujal. Why stock bonds are not included in GDP and why closing stock of raw material is included in GDP. See, stocks and bonds which are introduced, these are financial instruments, okay? So they are issued at a specific point of time. And then when we talk about over the years, they are in the market. So if you go for using it, it is not about that where it is about where the funds have been deployed. So companies, they go for raising through bonds, they go for raising it through IPOs. What is the core objective? To invest that money somewhere? No. So they have invested somewhere where you will be getting returns. So that is why it is not included. It will always be part of investments which they have done. Money they have got, but otherwise the shares are traded in the market. And what you get returns through dividends and others, which will be counted again, because that's a source of income for you, which you'll be using it. So bonds and shares, but when it comes to inventories, those inventories can be, for example, I say that you are a retail shop owner and there is, or let's say you're Marks and Spencer. So Marks and Spencer has surplus of inventories and it didn't get absorbed this year. So they can use it next year also, that they need not go for buying more. So that means that's a kind of add-on to their investments only, you know? So that is the difference between inventories and when it comes to, when it comes to bonds and shares. Okay, so this concept of net factor income from abroad, Kaveri wanted once again to share net factor income from abroad. See, concept of factor income, first you understand. What is factor income? Factor income is the income received by factors of production. What are factors of production? Factors of production are land. Then you have labor. So land is, you have land, you have labor, you have capital, and you have entrepreneur. Isn't it? So entrepreneur, so these are the players. So land gets what? Land gets rent. So you may have land in India. Foreign players may have purchased certain land and they have to pay the price, not pay purchase, they have gone for lease or something like that. So they have to pay the price for that. So that is one factor. So that is plus in India's books because they are giving it to us. Similarly, Indians working abroad and they have gone for some venture over there, they have established some, so they have to pay over there to that government, US government, UK government, African government, whatever it is about, it's minus. So what you receive is plus, what you give is minus from any factors of production. So Indians working abroad, they get money back home is about labor, wages, salaries, plus capital. Indian firms investing abroad is minus. Foreign firms investing in India is plus. So this is how. So you calculate the difference of that. That is net factor income from. So factor income received from abroad, factor income paid abroad. The difference of this is net factor income from abroad. Now what happens, especially for developing countries, Vietnam and other is different case, but China is different case. But when we talk about India, we go for more factor income paid abroad. This goes up, no? Factor income, what we pay abroad is more than what we receive from abroad. Since we pay more than what we receive, this NFIA becomes negative. And if this NFIA is negative, so here there will be negative sign. If this is negative, that means GNP will be less than GDP. So that is how it happens. So what we need to work on, we have to work on creating conducive environment in India. Factor income, we should get more than factor income what we pay abroad. So this is the component of net factor income from abroad. Okay, so this is clear to all of you. Nominal and real is clear. Since I can share once again. So when we talk about GDP, we took production. Production can be fragmented in two components, price and output. This price, if you keep constant, how do you keep this price constant? By taking base year. Base year we have taken 11 and 12. So you take prices of base year, you take output of 22. Output you are taking 2022, price you are taking 11 and 12. take a product of this. This gives you what? This gives you real GDP. Okay, so this is how. If we would have taken prices of 2022 and output also of 2022, then the product what you get is nominal GDP. And how do you get deflator? GDP deflator you get is nominal GDP divided by real GDP into 100. This gives you what? This gives you, this gives you GDP deflator. Is it clear? So this is GDP deflator. So the three, national income, what is national income? Basically, national income is NNP at factor cost. What is NNP at factor cost? NNP at factor cost is net national product factor cost. National, you understand, national is plus NFIA. So if you go from GDP, you remember always national income is NNP at factor cost. Net national. Net means you're moving from gross to net. That means what you're doing, you're deducting depreciation. So when you go from gross to net, I'm sorry for this handwriting. When you go from gross to net, what do you deduct? You deduct depreciation. When you go from net to gross, you add depreciation, number one. Number two, so we have converted G to N, isn't it? GDP, we had GDP at market price, you understand? We are moving from GDP to national income. National income is NNP at factor cost. What is NNP? NNP is net national product at factor cost. Net, you understand, when you go from gross to net, what do? You deduct depreciation. When you go from domestic to national, what do you have to do? When you go for domestic to national, you have to add NFIA. And if you go this way, then you deduct NFIA. Isn't it? So domestic to national, you add NFIA. Number two. Number three is factor cost. What is factor cost? We have shared this GDP is at market price. Market price means the price which is in the market today. Based on that, it has been calculated. If you want to go for factor cost, what is factor cost? Market price is the price which is quoted in the market. Factor cost is the cost for producer. So this is from producer's perspective. What is factor cost? Factor cost is about what escalates the factor cost, what decreases the factor cost. So if government offers subsidies, what will happen to factor cost? Factor cost will reduce. If government imposes taxes, then in that case, factor cost will increase. Are you getting it? So cigarette prices going up, alcohol prices going up, branded product prices going up. Why is it going up? Because tax is pulling up prices up. Government offering subsidies in farm products. What is happening because of that? Subsidies pulls prices down. And the net impact of this is in terms of net indirect taxes. What is net indirect taxes? What is net indirect taxes? Net indirect taxes is indirect taxes minus subsidies. Why do we take this? So if you have to go from market price to factor cost, what will you do? You will go for minus net indirect taxes. What is net indirect taxes? Indirect taxes minus subsidy. Why do we do this? We do this because taxes escalates the price and subsidies reduces the price. So if subsidies offered are more, then the tax imposed, then the market price will be less. So if you go this way from factor cost to market price, what do you have to do? You have to, if you go this way, then you add plus NIT. Is it clear? So these are the three rules of national income accounting. Positive, definitely, Mukta, positive NFIA is good. Then negative NFIA. If you get more factor income from abroad, that is better than what you have to pay to rest of the world. Is it clear? So what are the three golden rules of national income accounting you should remember always? Number one, we have shared GDP is the core, GDP at market price. And national income is NNP at factor cost. To move from GDP at market price to factor cost, what you have to do? NNP at factor cost. One, you convert gross to net. Gross to net is deduct depreciation. So you have converted G to N. Second is domestic to national. To go from domestic to national, what do you have to do? You have to add net factor income from abroad. So you add net factor income from abroad. Number three, to go from market price to factor cost, what do you have to do? You have to deduct net indirect taxes. This we have done from GDP at market price to NNP at factor cost. Is it clear? I hope it is clear to all of you. So national income is NNP at factor cost. Now suppose we are at NDP at factor cost. NDP at factor cost means net domestic product at factor cost. You remember D is for domestic, N is for national. So if you are at NDP at factor cost, then in that case, how will you get NDP at factor cost? If you have to go from GDP at market price, if you are at GDP at market price, you want to go for NDP at factor cost. That means you're converting this G to N, gross to net. That means you will be deducting depreciation. Secondly, you're converting you're converting market to what? You're converting this market price to factor cost. Here, what do you have to do to go from market price to factor cost? Net indirect taxes minus net indirect taxes. So if you are going from GDP at market price to NDP at factor cost, what will you do? You will convert this gross to net. How will you convert gross to net? By deducting depreciation. You convert this market price to factor cost by deducting net indirect taxes. So this is NDP at factor cost. Okay. Then if we go for this, if you have to go to NDP at, if you have to go to this NDP at factor cost, from NDP at factor cost, let's say you have to go to NNP at factor cost. So you are moving from NDP at factor cost to NNP at factor cost. How will you go? N is same, that is, it is at net. You have to convert domestic to national. How will you convert domestic to national? What do you have to add? You have to add NFIA. The domestic will get converted to national. Factor cost is same, so that's it. So any conversion you can do by simply remembering three golden rules of national income accounting. One, gross to net is minus depreciation. Net to gross is plus depreciation. I hope my handwriting is okay, or shall I write again? Domestic to national. Domestic to national is you go from domestic to national, you add an FIA. If you go from national to domestic, you deduct an FIA. If you go from market price to factor cost, what do you have to do? From market price to factor cost, you have to deduct net indirect taxes. What is indirect taxes? Indirect taxes is net indirect taxes is indirect taxes minus subsidies. Okay, so this is the conversion, and this is how you can do all your calculations. So national income accounting significance is clear to you. It helps you to identify growth of the country. It helps you to identify which sectors are performing better. It helps government to go for policy measures. It helps economy to perform better. It helps in better distribution of income. Those who are getting less income, Government of India works for them to make them be at par with others, to reduce income inequality in the country. It helps to promote those sectors which are having problem in terms of financial access to credit. So they help them in terms of credit accessibility. It takes care about inflation through, you come to know through national income accounting about the rate of inflation in the country. It helps to forecast for the future, which sectors leading to high inflation, what kind of policy measures to be taken for that, where to be given interest subsidies, where to be penalize them with high taxes. So that's the role of national income accounting. And this is another important concept. So what we have shared GDP, we have shared NDP, we have shared net national product at factor cost. We have shared 3 golden rules of national income accounting. You can convert any figure, any parameter with these 3 golden rules. What is one? Rule number one. Rule number one is domestic to national. What do you have to do? You have to go for adding net factor income from abroad. If you go from national to domestic, obviously you deduct. From gross to net, you have to deduct what? Depreciation. If you go from net to gross, you add depreciation. Number 3, from market price to factor cost, what do you have to do? You have to go for deducting net indirect taxes. If you go from factor cost to market price, you have to add net indirect taxes. So these are 3 golden rules you have to remember for any conversion, for any numerical, which are there. We will be sharing later in the next class, okay? Now the next concept is personal income. Why we are adding NFIA to domestic to convert into national? We have already shared what is domestic. Domestic is within the domestic boundaries. In domestic boundary, who are the players? You have Apple, you have Samsung, you have Uber, you have Netflix. Are these Indian players? No. So what we have to do? We go for taking care about net factor income from abroad. That means what foreign players in India are taking back home is minus, and what Indian players are getting it from abroad is plus. That is why NFIA is added when we move from domestic to national, because national is about whom? National is about residents of India, and these players are not residents of India. So that is why we add NFIA when we go for converting from domestic to national. Okay. So now we are talking about personal income. So by 8:10, I want to finish up with this so that we can go for taking your queries or revising everything. Okay. So personal income. What is personal income? See, there are different players in the market. One is government. Another is corporate players. Then we have household like me, you, and others. Okay. So these are the 3 major players. When we talk about personal income, when we talk about national income takes care about income of all 3 players: corporate, government, not only corporate, government, household, but also international players. National income. Domestic income takes care about the income of the government and household and the corporate. Personal income is income which is excluding corporate. Income excluding corporate. So you can see here personal income. What is personal income? Personal income here is, so personal income, you can see this personal income. Personal income is earned income. Earned income means income which is factor income. Okay, so factor income, what you have. Transfer income. This is another important concept, transfer income. So you have 2 categories of income. One is factor income and other is transfer income. Okay, so what is transfer? Factor income, you know, factor income is you render your services. Factor income, you as factors of production, you render your services, and in return you are paid for rendering your services. So you get paid for the services you have rendered is factor income. So land, labor, and capital, they get factor income in terms of rent, wages, salaries, interest, and profit. What is transfer income? Transfer income is you are not rendering any services, still you are getting money. So unemployment allowances, subsidies are component of what? Transfer income. Why they are component of transfer income? These are unilateral transactions, isn't it? So something like I tell you to make it more easy for you to understand transfer income and factor income. So after your chartered accountancy, you join a firm, you get a hefty salary, you contribute your services, in return you are paid. That is your factor income, isn't it? But today, you may not be earning, but you get money from your parents. Are you rendering any services in return of that? No, that is transfer income. So subsidies, people get subsidies, unemployment allowances. These are what? These are transfer income. Okay, so unemployment allowance basically means you're not working and still you're getting allowance. Transfer income. Income, what you get by not contributing or not going for any productive services as such, is known as transfer income. This is one-way transactions. Now you understand that if you get pocket money, if you get income from somebody who wants to pamper you, who wants to give you, so you are earning and still you're getting certain amount of money over and above. That means the money income which you have in your hand is plus of what? Plus of factor income plus transfer income, isn't it? So the total income for you, what you have in hand is personal factor income and transfer income. But when we calculate national income, we do not take transfer income into consideration. So please do remember, when we are talking about national income, this transfer income is not included. But when we talk about personal income, this transfer income is included. Because this adds on value, it adds on money in your hand, isn't it? So that is why it is included in transfer income is included. Why is it not included in national income? Because this is not leading to any exchange of goods and services. We have shared, no? So there's no exchange of goods and services. So that is why it is not included. So only factor income is included in national income, but transfer income is included in personal income. Do remember this. And you understand the difference between transfer income and factor income? I hope so. So what is personal income? Personal income is income earned, transfer income received by household from all sources within and outside country. So people get money within the country from the government support or from any other means without contributing, and they can get outside support also. So that is personal income. So personal income is clear. Personal income is income within the country plus transfer. So transfer payments are included in personal income. Do remember this, but it is not included in national income. So personal income is private income. Private income minus corporate tax. Why we deduct corporate tax and undistributed profits? Because this is the income of whom? This is, you have paid for the shares and others to the corporate, household have paid to the corporate for investing, generating returns, but they are not passing on to you. So undistributed profit. So it is not coming back to you. That is why it is minus. Then corporate taxes are minus because they are again given to the government, corporate income tax and others, corporate income tax and others, but it's not coming back to you. So that is why these are deducted. So private income, from private income to get personal income, what we do, we deduct corporate tax and undistributed profits. Is it clear? Undistributed profit, you understand? Profits which firm has gained, but they do not pass it on to their shareholders in terms of dividends and others. They go for retaining that profit. That is undistributed profit. So it is not passing on to the shareholders, and that is why it is minus. Corporate tax as such, it goes to government, so it is again minus because it is people's money which they have invested. So you understand share market where people go for investing, the corporate, they go for deploying that money. So that is what it is deducted here. So personal income is clear. Personal income, if you go from national income to personal income, what do you do? National income minus income, because this is the income of whom? This is the income of the personal level. So then in that case, income of the government has to be deducted because it is personal is not inclusive of government, so government income is deducted. Corporate tax, I've already told you, we deduct from national income. So national income comprises of what? National income comprises of private player, national income comprises of government. So in this case, from national income, we deduct income of the government, then you get the private income. So this private income, once you get from private income, you deduct what? Corporate tax and undistributed profits and all transfer payments you add. That gives you personal income. Okay, so personal income, you can get it through national income. Personal income, you can get it through private income. If you want to go to personal income from private income, what do? You deduct corporate tax or undistributed profits. If you go to personal income from national income, what do you have to do? You have to deduct income of the government, income accruing to the government. So income accruing to the government has to be deducted, apart from other things, because the rest is all private income. If you want to go to personal income from NDP at factor cost. So NDP at factor cost means you add NFIA, that gives you national income. Then you go for net interest payments by households and corporates. What is meant by net interest payments by households? Net interest payments by household means you invest, you invest, so you get interest payments. You borrow, so you pay interest. So interest what you pay and interest what you receive. If you have to pay more, then it is minus. Okay, so interest payments you are making, that means it is minus from your income. No. So interest liabilities are more on your head, that means it is minus. So what we deduct to get personal income from national income, we deduct interest payments, net interest payments by household, we deduct corporate tax because you have invested, you're not getting that money, so it's minus in your books. Undistributed profit, again the same. Transfer payments we add because that's added up in your income. So personal income depicts about what? More income you have, more you can spend. More you can spend, better is your lifestyle. Better is your lifestyle, better is your standard of living. That talks about welfare of the people. This talks about welfare. So personal income talks about welfare. Transfer income. Okay. Transfer income is basically income which is one-way transaction without contributing in any productive activity. For example, fertilizer subsidy given to a farmer. For example, for buying a tractor, subsidy given to a farmer. Is the farmer paying back something to the government through that? No. But they're getting subsidy. For example, unemployment allowances. Those people who are unemployed, they get allowances for not being working. That means, are they contributing anything back? No, but they're getting money in hand. That means it is transfer payments. Okay, transfer income, transfer payments is this. Okay, so I hope it is clear to all of you. So we have shared this personal disposable income. What is personal income? You understand? Personal income is from private income when we deduct corporate tax, undistributed profits, and we add all transfer payments, we get personal income. From personal income to disposable income. Disposable income means which you can spend on consumption or you can save. So how will you get that disposable income which is ready for you to dispose of in any form? You consume or you save. So personal disposable income here, how will you get personal disposable income? You already know how to get personal income. We've already shared. From personal income, you deduct all your taxes and all other non-tax liabilities. So if you have any tax liability on you or any non-tax liability you have taken from someone, you are liable to pay to that person. Any other obligations you have. So whatever financial obligations you have, you pay for that, and whatever remaining amount is there with you to spend or to save is personal disposable income. So how do you get personal disposable income? From personal income, you deduct personal income taxes, what you're liable to pay to the government, and all other non-tax liabilities which you have on your head. So if you go for deducting these two, the remaining money or income which is there, I mean to say economy we are talking about, okay? Economy means households we are talking about. So all households income together after deducting income tax and all their non-tax liability, you get personal disposable income. So higher the personal disposable income, better is the quality of life. Better is the quality of life means higher is the per capita income, and it is a progressing country. So countries which have higher personal disposable income means they are better off than countries which have lower personal disposable income. Okay, so that is the comparative personal disposable income. Then so we have shared personal disposable income for household. Similarly, at national level also, there's a concept of national disposable income. So for national disposable income, again, you'll add all current transfers from the rest of the world. Current transfers from the rest of the world means World Bank giving you some money during pandemic, which they are saying you are not liable to pay it back. So it is transferred to you. Similarly, India giving to countries which are having tough time during this pandemic or others, that is minus. So that's about net national disposable income. NNP at factor cost, you understand what is NNP at factor cost? We have already shared. NNP at factor cost is, so NNP at factor cost here is, one second. NNP at factor cost, you understand NNP at factor cost is net national product at factor cost. How do we get net national product at factor cost? You know from GDP at market price, how to get at NNP at factor cost. What you do, you deduct depreciation. What you do next, you go for adding NFIA, net factor income from abroad. Then what next you do? You have to go for, you have to go for minus net indirect taxes, because you're going from market price to factor cost. If you go from factor cost to market price, you go for plus NIT. If you do these, you get an NP at factor cost. Net indirect taxes, we are already here, so you need not go for this here because we've already taken care net indirect taxes here. Net current transfers, you understand current transfers, what you pay to the rest of the world is minus, and what you get from the rest of the world is plus. So whatever relief, aid and packages we are getting here is plus. What we have to pay to the rest of the world, what we accommodate to other underdeveloped countries is minus, because it goes out from here. So that is net national disposable income. Gross would be, because we are talking about net to gross, that means here we are adding plus depreciation. Rest is same. Okay, so that's what we said about initially was about personal income of the household. What we're talking now is about national disposable income. So domestic income of a country has two core components: income to the government sector, income accruing to the government. Government departments are there. There is Department of Telecom, there's Department of Health, there's Department of Education, there's Department of Road and others. So there are the banks. So they are the ones who get income, through that government gets income. Other is through their non-departmental enterprises. So you have SAIL, you have GAIL, you have NTPC. So these are non-departmental enterprises through which they get income. So this is the source of income for the government. Other segment which gets income in the domestic income category is private players. Private player income, they get it from what? They get income from property, entrepreneurship. When you deduct income of the NDP at factor cost, from income from NDP at factor cost, so when you from NDP at factor cost, you deduct income to the government, income accruing to the government, you get what? Income accruing to the private sector. And from this private sector, when you deduct income of the corporate tax, and then net interest liabilities you add, and then you go for undistributed profits, you get what? You get personal income. So you understand NDP at factor cost means you have government income, you have private players income. When you go from NDP to private income accruing to the private sector, what you do? You deduct income of the government. This income you deduct. You get private income, private sector income. And from this you deduct all undistributed profits and corporate tax and others, you get personal income. And personal disposable income, you deduct all tax liabilities and non-tax liabilities, you get personal disposable income. So these are the components to understand. Private income, I've already shared. Private income is income of corporate plus households together. Core, you should remember one core factor that is about transfer payments. So transfer payments is very important to understand. So I hope you will remember transfer payments, transfer income. So this is about net current transfers from the rest of the world. This is included only in private income, personal income, and personal disposable income, but this is not included in national income. So transfer payments are not included in national income. Okay, so this is what is private income. Now, this is one activity which I want to share with all of you. See once again question. Tangible, we go for gifts, not in terms of what you say about physical as such, but when we go for monetary terms is transfer income. Okay. Samruddhi, this interest income is included in the NDP factor cost. Why again deduct the net interest of the household? No. Net interest is not included. You remember we have shared what are the three components we talk about. Household income. Household income is in terms of wages and salaries, isn't it? We are talking about net interest income. No, wages and salaries. Talk about wages and salaries. Okay. So this is the question given to you. You can see here. I want you people to work on it at your level and just find out. Can you see my screen and all the figures here? So what is given to you? You have been given NDP at factor cost. What is NDP at factor cost? NDP at factor cost is net domestic product at factor cost. They have also given you NFIA. What is NFIA? Is net factor income from abroad. Other components given to you is personal undistributed profits. What are undistributed profits? These are profits which firms have gained through their venture, but they have not passed on to their shareholders in the terms of dividends. They have retained it. Undistributed profits are retained. They have retained it. Undistributed. Corporate tax. Corporate tax is the tax which corporate have to pay from their profits. So again, it is part of the taxation given, but is it part of private income or not? That you have to think. Interest paid by households. Interest paid by households is 1,200. Interest received by households is 1,500. That means here the net interest liability is, they are not having net interest liability, they are having plus here. So you do take care of this. Then you have personal taxes. Okay, personal. So these are the components given to you. Now suppose you have to calculate personal income. Just calculate personal income fast. What will be personal income? Can you calculate personal income? How will we calculate personal? What will be the answer for personal income? Can you calculate? Please calculate personal income. I'm waiting for all of you to answer this. Personal income. How will you calculate personal income? What are the components of personal income? You have to take NDPs given to you. So NDP is 8,000. Net factor income from abroad is 200. Undistributed profit is 1,000. What should we do of the? Let's go for adding and deducting respectively. So NDP at factor cost, NFIA, should we add? Should we not? Should we add or should we not add? Come on, fast. I'm waiting for your answers. Private income. How will you get personal income? First and the foremost, personal income. So what you have NDP 8,000. You have NFIA 200. These to be added, yes? No. Kaveri, it's not right. 6100 is not right, my dear. It's not right. This is 8000 plus 200 will add. What do we get through this? What do we get through this? We get NNP at factor cost, okay? By adding these two, you got. Now what you have to do, you have to deduct undistributed profits because this was your money which you didn't get because corporate have retained it. So minus 1000. So 8200 minus 1000 is 7200. In this corporate tax further to be deducted. So you deduct corporate tax. So this also will be minus. This is minus. This is minus. These two are plus. Then interest received by household is 1500. Paid by household is 1200. So it is plus rather. This is how much? 300. So 300 plus. Okay. Then this we have done. Then transfer income, you know, we have to add. So we have added this. What's the sum now? Calculate the sum. Absolutely right. Rashali has calculated right. 7,300. Rashali, your answer is right. 7,300 is the answer. Okay. So personal income we have got. Now you have to go to private income. How will you go to private income? So what is the difference between personal income and private income? Private income is inclusive of, because private income is whose income? Private sector. And undistributed profits and corporate tax are part of this. So what do you have to do in this case? What will you do in this case? In personal income, you will add corporate tax. You will add corporate tax and you will add undistributed profits. You will get what? You will get private income. So from personal income to private income, what do you have to do? You have to add corporate income. What is corporate income? Undistributed profits and corporate tax. So what's the value you get here is, people, have you calculated? Yes, Satish has calculated, right? Kaveri, you are getting wrong. 6,800 is wrong, my dear. 6,200 is also wrong. 6,800, you are calculating personal disposable income, Kaveri. 6,800. Absolutely. Chetna is right. Yes. So this is how you have to do. Okay. So this is clear. You need some time to understand concepts. Once the concepts are clear, just make a flow chart. I'll also try to make a flow chart and share with you people. So once you have a flow chart, it makes you easy to understand. So these are the subsets. Okay. So we can move from national income to personal income, national income to private income to personal income to personal disposable income, isn't it? So these are the factors which you have to remember. Do please keep it in mind, corporate tax and undistributed profit. We have shared domestic income. Which are the two players? Government and private. Government income accruing to the government is through which sources? Through departmental and non-departmental. What about private income accruing to? Private income is based on what? Accruing to the private sector is national income minus income accruing to the government is private income. Accruing to the private sector. And from private income, you can deduct undistributed profits, corporate tax, net interest, liability of households. You will get what? And add transfer income, because transfer income is added in personal income, private income, and personal disposable income, but it is not added in national income. Okay, so that is one. Now, this is activity 2. If you can see here, we have shared GDP. If you have to calculate output growth rate of the country, you know GDP is the measure of output. So if you have to calculate out GDP growth rate, how will you calculate? You will take real GDP, because you remember real GDP gives you the correct figure of output. If you take nominal GDP, it may be because of price level, inflation. So we keep prices as constant. We take output growth. We want to find out output growth. So to find out output growth, we'll take real GDP. So real GDP of the current year, 2022, real GDP of 2021 minus divided by real GDP of 2021. This is how you calculate growth rate. So you can find out the real GDP growth rate, how it has changed. So if this is in USD terms, if you say $1,000 to 1,200 to $28, then in that case, how much is the output growth rate? Output growth rate will be how much? 0.028. 0.028. And if you multiply it by 100, you can get it 2.8%. So GDP growth rate will be 2.8%, which you can calculate in percentage here. That is all about this. I want to recap things before we wind up for the day. If you have any queries. No. Jayant, in case of personal income, we will not deduct taxes, because when we talk about personal disposable income, then you'll deduct taxes, okay? So personal, is it clear, Jayant? When you go for personal disposable income, because when we talk about personal disposable income, at that point of time, you want to use that income either for consumption or savings. But if there are tax liabilities on you, then your net income, which will be in your hand, will be less, no? So there we go for deducting taxes. But when we talk about personal income, there we do not go for deducting taxes. So if all of you are okay, I'm sharing in English is fine, or if you want me to sum up in Hindi, I'll do it. Not core Hindi, but I'll try my level best if you want. Otherwise, I'll sum up like this only, whatever you say. Yeah, money get vouchers. Yes, definitely. Anything what you get without contributing. Okay, so I just want to recap before we wind up for the day. So we started number one. You can see my screen, I hope so. We started number one with why this paper, that you will understand gradually as we'll proceed. Today we have shared national income accounting terminologies and some application part of it. Next class, we will be doing all calculations of national income accounting. So I hope you understand. We have started with national income accounting. Then you have public finance, where we will be talking about expenses, how government meet the expenses, how government go for various projects, financing and others. Finances basically takes care about all. It's revenue, it expenses, everything. And then we'll talk about money demand and money supply. So this is how then you will have international economics, where you'll talk about international trade policies and others, theories and others. Okay, so this is how this paper has been framed. We have today shared basics of national income accounting. I hope you can understand what is the meaning of national income. Meaning of national income is it depicts about country's health. It depicts about the macro fundamentals of the country, how country is performing. How can you quantify this? You can quantify, you can get the information through GDP. You can get it through income method. You can get it through output method. You can get it through expenditure method, which we'll be sharing in the later classes. Today, we have shared GDP. GDP is a production-based method. We have shared about value-added method, how the value is added at each step. It talks about the contribution of each sector from agriculture, manufacturing to service sector. This depicts about how different sectors are contributing and how these sectors' contribution over the period of time has increased or has contributed more over the period of time. How many people are employed over there? How many percentage of country's population is deployed over there? How much contribution they are making? The more and more you see transition from agriculture towards industry, towards service, contribution in GDP, that depicts about the growth of the country. That's why you see US and other countries, China and other countries, if you see, their contribution in GDP is more through manufacturing. India's contribution was more through service sector, but people employed maximum were in agriculture sector, but their contribution is minimum. That talks about more and more people employed in agriculture, but their contribution GDP is very less. That talks about low per capita income and developing country or underdeveloped country. But more and more people are employed in service sector and they contribute more and more. That depicts about growth of the country or the development stage of the country. So this is how national income gives insights about. We have shared what is the role of price in national income accounting, which tells about, we have shared production tax and product tax. So why government should offer subsidies to micro, small and medium enterprises, why government should subsidize education in India, why government should subsidize marginal housing, those who want to buy a house, marginal set of people in India, why government should impose higher tax rate on branded products, why government should impose higher tax rate on products which government wants to discourage, why government should offer subsidies. We have shared domestic and national. Why Amazon in India is a part of domestic. Why Amazon is not a part of domestic when we talk about national. Why India's national income with respect to domestic income can be less because of the net factor income from abroad. What we get is less than what we pay abroad. Why the nominal and real difference is there. So then we have shared about significance of national income. I hope it is clear to you. I've shared these three methods we will be doing in detail next class. I've told you core is production, and the core of production is based on what? Labor and capital. Labor and capital, one, in India, we have huge quantum of labor, but we have less skilled people. So Government of India working on skilled people, Government of India working on education, new education policy. These all are going to enhance productivity of human. Government of India working on training and development. This is going to help in terms of productivity enhancement. So production will increase, output will increase, but the price level will not increase because the cost will not increase. So it will be increase in real GDP. This real GDP will improve quality of life of people, which will talk about equity of people in terms of income distribution also. Because more unskilled people getting trained, that means their source of income will increase. Income increases means your purchasing power increases. Purchasing power increases means you create demand. Demand means companies, they go for investments. Investment means growth of the country. So GDP is the fulcrum of the country because it talks about production. So production has, what are the two attachments with the production? How much you create demand for it, how much companies they go for investment in it, and how much is income generated through that. That is national income accounting, what we have shared. I will be sharing these notes with you. I will also be sharing with you how Government of India is calculating national income, what are the subcomponents of it. You can go through that. If you have any queries, we can share in the next class. You can also write your queries in the chat, questions. I'll take care of that. And then we have shared personal income, private income, personal disposable income, even national disposable income. So I hope terminologies are clear. I have gone at a very slow pace, keeping into consideration that this first class, maybe you are not so comfortable with the concept. So gradually, once you are acquainted with these terminologies, it will be easy for me and you also to proceed in a at a more faster pace, I believe so, or maybe at a moderate only. Don't worry on that account. So let's end the session today for this. I hope it is clear to all of you. Personal tax, that's what I shared, Kaveri. That is deducted once we go for personal disposable income. Isn't it? So personal tax you only go for when you calculate personal disposable income, not when you go for. So personal disposable income 6,800 is right because over there you have deducted taxes. So that way it is right. Okay, so good night and bless you all. May you all remain healthy, happy and fit and study national income accounting very well. Okay then, bye. Take care all of you. Okay then.